Looking at people's portfolios is routine for us. Last week, I was over at my friend's house and he asked me to look over his investment portfolio and it had over 100 stocks in it. Is 100 stocks too many? Is there such a thing as having an over diversified portfolio? Does concentration work better than diversification? That's the topic of this video today. So let's get into it. Make sure to like, subscribe, and comment on this video. It really helps us out with the YouTube algorithm and helps us reach more people. If you don't know anything about investing, you'll start with understanding diversification first. Add more stocks into your portfolio, diversify your portfolio, and that proves as a fail-safe way to mitigate the risk. And that's kind of the gist of it to a degree. Now, when we're constructing a portfolio, we try to optimize the risk against the reward. As we add more stocks into a portfolio, the magic of diversification, it helps reduce the stock specific risk. Here's a graph that illustrates this concept a little better. You can look at the portfolio standard deviation, which is the risk, against the portfolio size, which is the number of stocks that are held in a portfolio. And as you can see, as we start adding an additional stock, starting from 1 to 2 to 3 to upward to 10, we see a massive drop in the portfolio risk, right? And as we continue on from 10 to 20, we see that there is a drop in the portfolio's risk and the percentage drop isn't as high as what we saw between 0 to 10. What is evident from this graph is that there is this concept of diminishing returns of adding a new stock or another stock to a portfolio, and the diversification benefits do tend to taper off as we add more stocks into a portfolio. Now, what is the right number of stocks that you should have? At which point does it taper off? Those are all sort of conceptual problems and we'll try and get into it. But conceptually, this is the broad theme that you should sort of understand first.
So how many stocks to have in your portfolio? I think that is the big question that we want to answer in this session. Sometimes we come and tell you that diversification is so beneficial, right? You should have a diversified portfolio. And in other times we come and tell you that, let's have a concentrated portfolio. So which is better? So to understand this, let's look at an example that you had, 100 stocks in one portfolio and 10 stocks in another portfolio. If one of those stocks rallies 10%, the overall impact in the 100 stock portfolio will be 0.1%. Whereas when it rallies 10% in a 10 stock portfolio, you will see that, 1% impact on the portfolio. So if you're very confident about the stock that you're betting on and you see the potential of them growing rapidly, then you should go with a concentrated portfolio. And that is where Alpha Prime by Wright Research comes in, right? So whereas we've had portfolios that have 20 to 30 stocks all throughout the last 4 years, recently we've launched Alpha Prime, which is a basket of 10 concentrated stocks where we see where we are very confident about their momentum, right? And that portfolio, we launched around 3 months ago, has done tremendously well, 36% absolute returns during the last 3 months, and has been a favorite of investors. Thousands of you have come and invested in that portfolio. That's an excellent portfolio for high-risk investors who want to take advantage of the market by focusing on the key set of momentum stocks and make the most out of it. But you also have to understand that there's a risk associated with it. Along with our Smallcase, which is already there on the Smallcase platform, as you all know, Wright Research has also launched our PMS. And in the PMS, we keep on getting investors asking us to, give them exposure to Alpha Prime as well. So within the PMS, we're creating a 10 stock basket called the Alpha Prime PMS, right? Alpha PMS, which would be available for people interested in the PMS as well. So please head on to, our PMS website or our Smallcase website and get a flavor of the Alpha Prime portfolio.
So far we've understood that there are some diminishing returns to diversification benefits of adding a new portfolio into a stock doesn't necessarily have the same benefit in terms of portfolio risk reduction as it did when we added the first stock or the second stock or the third stock, right? There is this graph that goes down. Let's look at a Yale study that was conducted in 2006 where they coined the term active share. What is active share? Active share is how much the fund's holdings differ from its benchmark index. And this concept is what the study really sort of imbibed, and it spoke about it in the context of mutual funds. And in that study, in terms of mutual funds, they found that mutual funds with low active share, that is less than 60%, significantly underperformed their benchmarks by about 1.37% on a yearly basis. When we look at small cap managers, We noticed that this was obviously a bigger and a wider trend, but it was also observed for large cap funds. Why is a low active share a problem? Well, a problem with a low active share fund, let's say, is that the fees are very similar to actively managed funds, but the performance is also very similar to the benchmark, right? And ultimately, what's happening is that you are paying out of your pocket for that underperformance, the underperformance of just matching what the benchmark could have given. Other studies that support the notion that concentrated portfolios, those where the fund manager places significant bets on a few number of stocks, are more likely to outperform. One study identified that the best ideas within fund managers' portfolios are by assessing positions' weights relative to their benchmarks. And these best ideas outperformed other positions in the portfolio by about 1.6% to about 2.6% on a quarterly basis. Another research piece found that fund managers with concentrated portfolio outperformed the diversified counterparts by about 4% annually, attributing this superior performance specifically to their largest holdings. Despite the evidence that is there to support concentrated portfolios, large fund managers do opt for diversification, or rather over diversification. And there are four broad reasons for this. The first one is to maximize the fee revenue. A more diversified portfolio allows for the fund size to be larger, and thereby it increases the overall fee income, which obviously maximizes the revenue for the fund manager as well. The second point here is risk aversion. Managers who underperform the benchmark have a higher risk or a higher loss of losing their job, right? That's their risk essentially. So by maintaining a very diversified portfolio, or rather an over diversified portfolio, that can kind of serve as a safety net, because you're ultimately not going to underperform the benchmark at least, right? Third point, institutional constraints. Obviously, there are large funds out there, specifically in the case of mutual funds or even pension funds, let's say, right, which are often limited to investing in the most widely known, the most widely owned, and the ones that have a lot of analysts looking at it. And this is typically just a regulatory measure that has been put in place, and that obviously means that those portfolios or those funds are very, very diversified. Finally, funds who have chosen diversification also appear to be more attractive on certain performance metrics like the Sharpe ratio. And even though there is obviously certain evidence that this can dilute performance.
Again, concentration versus diversification. How many stocks are too many in a portfolio? So it totally depends. Sometimes fund managers some of the fund managers, they would say that, a diversified portfolio should have, 40 to 45 stocks, and, a concentrated portfolio is 25 to 30 stocks. Whereas other managers might say that a 10 to 20 stocks is concentrated, whereas 20 to 30 stocks is highly diversified. So I think that decision varies from fund manager to fund manager. And to understand, how many stocks to have in a portfolio, we looked at a research done by John Wiley and Sons that we are going to show you on your screen. So if you look at this chart that is there on your screen, you will see what John Wiley and Sons did is they looked at 8 different size portfolios, one with 10 stocks, 15, 20, 25, 30, 50, 100, up to 250 stocks. And then they created hundreds of portfolios using these number of stocks. What they did was they looked at the distribution of returns over, these different size stocks over different horizons. And what they saw was that a 250 stock is very similar to the S&P 500. So, once you over diversify, I think the returns sort of become similar, that the variation of returns becomes similar. But if you look at this pink line, which is the most concentrated stock portfolio, which has 10 stocks, you will see that, it goes both ways, right? So in one set of stocks, this one has given a 21.3 return, whereas in another set of stocks, it is 3.7 returns. So the variation of returns is very wide, right? It can go very high or very low as well. Whereas if you look at the 250 stock, it seems to be within the range of 100 to 13, right? So it doesn't vary that much. So you can see that the 10 stock portfolio can give you high risk as well as high return. And that is what we keep on saying when we talk about concentrated portfolios. If you look at the chart on your screen, you will see that the 10 stock portfolio has the maximum amount of variation. It goes from 3.7 to 21.3, whereas the portfolios that have the largest number of stocks seem to have this amount of variation, right? They are only changing from 10.7 to 13.5. The ideology behind concentrated portfolio actually came from noted economist John Maynard Keynes. He said that, he talked about concentration in his book, General Theory of Employment, Interest, and Money. And Benjamin Graham, he quoted John Maynard Keynes in his book, Security Analysis, in 1934. So the quote by Keynes goes something like this, that as time goes on, I'd get more and more confident that the right method of investment is to put very large amount of money into companies in which you know something about and where you feel confident about their management and their potential, right? He says that he believes that very rarely do people get the advantage of investing into a large number of companies which they know nothing about, right? And he believed that as he reached the maturity of his life, he believed that there were hardly more than 2 or 3 companies where he could put his money in to get the most out of it, and where he passionately felt that he could invest into these companies. So the theory of concentration came from Keynes, and if you look at investors like Warren Buffett, Charlie Munger, you'll see that they also have a very highly concentrated portfolio. So in May 2023, 63% of Berkshire Hathaway shares, which was $333.4 billion, were held in only 3 stocks, right? So the mantra for concentrated investors is that hold fewer but stronger stocks for longer period of time to mitigate and amplify returns. So obviously, if you're holding a fewer number of stocks, up to three stocks or so, you would get big returns if those stocks perform, right? But the risk could also be there if you if you are holding to very few number of stocks. I think if you really believe in a set of stocks, the idea is to hold a small set of stocks and hold them for a very, very long time. But how long? I think that is something to think about.
Ultimately, the decision of including a stock really rests with the fund manager or you yourself if you're managing your own portfolio, right? And fund managers will typically have different strategies for picking these stocks, and depending on how strongly a manager feels about certain stocks over others, the number of stocks in the portfolio can vary. So in terms of what is the right mix of stocks that you should have in your portfolio, or what is the ideal size here, that really depends on your own individual situation, right? Let's look at a couple of scenarios here. Let's say if a fund manager strongly favors some stocks over others, it might be better to have a smaller portfolio in that sense. Initially, you may start off with adding more stocks to reduce sort of risk in the portfolio. Ultimately, you might not be sacrificing a lot in terms of the potential returns that could be earned from that portfolio. However, you will reach this sort of critical point after which adding more number of stocks can actually lower the expected returns without significantly reducing the risk. In such a case, let's say if it's a concentrated portfolio, looking at maybe 10 to 15 stocks is what is the ideal number there, because you want the concentration benefit while having a bit of the flavor of from the diversification benefit as well, right? This obviously helps remove certain stock specific risk, but it also helps reduce the overall portfolio risk. On the other hand, if the fund manager feels good about a larger set of stocks, then a bigger portfolio can be advantageous, right? In those scenarios, it makes sense to continue with sort of reducing the risk by adding more stocks without necessarily hampering the returns of the portfolio. In such a scenario, maybe 20, 25 stocks in a portfolio could be the sort of optimal number. Ultimately, the aim that you sort of have to think about is what is the right mix or the right balance for reward and risk, and how you can sort of manage that balance effectively. The number of stocks that are in the portfolio will ultimately depend on how selective the manager is about the stocks that are going into that portfolio as well, right? For retail investors who aren't as savvy or who don't have the time or the expertise or the energy to sort of spend into doing that research and really sort of doing that necessary groundwork for this, concentration could be an unacceptable risk, especially if you're doing this on your own. So let's say if you're looking at mutual funds, you should consider, let's say, not necessarily concentrating it, but at least not over diversifying your portfolio, not having more than, let's say, 6 to 8 mutual funds at any given point in time. And within those 6 to 8, there shouldn't be a massive amount or at least a significant amount of overlap between each of the funds that you've selected. Right? The ideal approach here is to have a unique mutual fund catering to a unique idea that you have. When we look at investing in equities, we can consider, let's say, a few equity baskets or small cases if you're not interested in sort of going into the direct equity market yourself. And in that case, you need to consider what are your specific goals. And in this case, you could look at a few concentrated portfolios that match your risk appetite, which could help boost the overall portfolio's performance as well.
So while we are talking about a concentrated portfolio like Alpha Prime, and we want to tell people about the advantages of it, let's also understand what could be the advantages of diversification, right? So when you are diversifying your portfolio, you are not putting all your eggs into one basket, right? What that means is that your stocks will come from different sector, different industry with different levels of risk. So even if one of them goes through any correction, your overall portfolio will not be impacted, right? And if let's say there is a sector which underperforms, there might be another sector that could support it, and could give you a potential for better returns as well. And as we saw in the example that we were looking at, that capital preservation, happens the most in a very diversified portfolio, right? Because it doesn't move that much. So it has a higher potential for capital preservation. You are looking at a bunch of opportunities, even though you are very, very diversified. The volatility gets reduced a little bit, and there's a little bit of flexibility that you would get out of a diversified portfolio. It could also be protecting you from market cycles and this and that. But like we said, once you have over diversified, then, getting that portfolio to move rapidly in any direction would be very, very difficult. And I think that is where a concentrated portfolio comes in.
Diversification is often seen as a free lunch. But let me tell you, there are no free lunches not in investing, right? Let's look at some of the risks that are still involved when you are diversifying, or at least some of the things that you should be aware of when you are looking for making a diversified portfolio. First, diminished returns. Over diversifying can lead to average or below average performance for your portfolio. Second, the complexity. If you have too many assets in your portfolio, if your portfolio is over diversified, and diversification ultimately really depends on what you think is the right number of stocks that you should have in your portfolio, then it could be very difficult to manage each of these individual assets and to understand the nitty-gritty that is involved in the research and why those assets were involved and why they were purchased and when to sell them. And that can lead to a lot of errors, a lot of oversight, and ultimately could hurt the overall return of the portfolio as well. Third, there are costs associated to doing this. More stocks typically means obviously adding more transaction costs. There is obviously the concept of reducing the net returns that will come to you. But there are also hidden costs here, which is that you are not able to understand or evaluate each of the stocks that is in your portfolio, especially if it's over the, let's say, the recommended or the ideal level here. And that could really hurt you in the long term. Fourth point, the lack of focus. It can also dilute or have an impact on the overall performance of your portfolio if top performing stocks get diluted by adding a lot of subpar stocks that don't necessarily perform and don't necessarily help reduce your portfolio risk as well, right? So that's something that we really need to consider here. And finally, I think the fifth point to consider is overconfidence. A diversified portfolio may also lead to this false sense of security and doesn't necessarily protect you against all shocks, right? What it does is it protects you against stock specific shocks, but there are obviously inherent market risks that are involved in any investing environment, and that is something that we all need to obviously be considerate of. Diversification is a tool, it is not a guarantee. Always keep that in mind. Always consider a lot of these different risks that come with diversifying your portfolio. Just to sort of drive home the point really here, let's look at a few different scenarios. The first one that I want to highlight to you is, let's say if you're in a scenario where there are high returns across the board, right? You're able to find lots of opportunities in the market to make good returns from adding those portfolios stocks into your portfolio. Diversification is beneficial in this scenario. As you add more stocks into the portfolio, that can help improve the returns without increasing the risk. In such markets, spreading investments is not just safe, but it is also advisable. The second point here that we need to consider, diminishing returns with each new investment. For every new investment that you're adding to your portfolio, there is a lower return for the given risk than the previous stock that you added into that portfolio. Then diversification can be detrimental. In such scenarios, a concentrated portfolio or a less diversified portfolio is actually better for you and for the returns that you need to generate. Excess diversification hurts returns. This is a point that we've already driven home, I think, in this video. If you have too many stocks in your portfolio, for every stock that you're adding into that portfolio again and again, the research that you need to do, the costs that are associated with it, all of this becomes a lot of problem, right? Now you're obviously wondering, how can you analyze a lot of these stocks? What is it that, what are the tools that are available? There are obviously robo advisory services such as Wright Research. They're extremely fast speeds, and they run these sort of algorithms, do quantitative research, have these very deep ML and AI models that are able to do a lot of this analysis. And obviously technology solves a lot of the problems that we've been speaking about in terms of analyzing and doing that research of the stocks. But at the end of the day, if you keep adding more stocks to your portfolio and you sort of breach that diversification limit, then there will be a necessary cost associated to it, and that's something that you need to always be aware of.
So if you want to look at the performance of this strategy, you can go over to Smallcase. You will find Alpha Prime by Wright Research, and you can check the performance there. You will see that in less than 3 months, the strategy has given 36% returns, which is quite amazing. If you head over to our website, which is wrightresearch.in, and look for Alpha, you will also find the back-tested results of the Alpha strategy on our website, right? And you will see that, the strategy has given tremendous return, at least in the backtest in the last 5 years period. And that is something that makes concentration highly attractive, right? That if you have picked the correct set of momentum stocks in a trending market, then you will get very sharp appreciation of your capital if those stocks outperform. And that is what the Alpha Prime strategy talks about. And you can study the risk, return, and rewards of the strategy in various sections on our website. Now let's talk about Alpha Prime on PMS. Now this is the new launch of the Alpha Prime strategy on PMS. So if you're an investor who wants to do this concentrated investing, even within our PMS, we're launching a scheme called Alpha Prime. No, not Impact Alpha Prime, but Wright Alpha Fund in the PMS structure, where you can invest into Alpha Prime like strategy. So while the philosophy behind both of these portfolios are the same, you will see that the allocation would differ and there would be a difference between the two portfolios. Wright Alpha Fund, which will be on the PMS, you can look at the backtested returns of it. You can see that it gives you very sharp returns when the markets are strong, but the risk is high when the markets correct, right? But if you want to get a flavor of momentum investing and you want to get a flavor of high-paced returns, but you are willing to take high risk for it, I think Wright Alpha Fund might be a good allocation within your PMS. So if you want to invest into the Wright Research PMS, you can have different allocation to different strategies as well. So even within the 50 lakh, you can have, certain percentage into factor fund, certain percentage into alpha, certain percentage into the hedged portion. So you can pick and choose your allocation within the fund as well. And we are very excited to launch this in the PMS structure as well. And we think that, this scheme will help us take big advantage of the trending bull market. Like always, thanks a lot for watching our video, and please subscribe to our channel, leave your comment, and we'll be very happy to engage with you. And with that, we'll wrap up. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to like this video and subscribe to the Wright YouTube channel. We will be back with many more insights, reviews, and market updates in the coming weeks. Till then, click on the bell icon to stay tuned for more such amazing Wright updates. Happy investing.